So let's take a moment to cover another profitability measure that can give you some healthy insight into the management effectiveness of a company. And the one we're going to talk about today is ROE, which is return on equity. So what exactly is it? Well, it's stockholders' return on investments. It shows the rate at which shareholders earn income on their shares. ROE does not take stock price into account. So return on equities doesn't in any way take the current price into account. And that's a good thing because the market can be crazy, it can be fickle, it can be highly volatile. ROE is a profitability measure of a company, and it suggests how efficient the company is at generating profits. Simply knowing ROE doesn't really tell you much. You have to compare it to historical ROE. Going back a few years is always suggested, and at some resources I saw that they recommend 5 to 10 years. Now, in order to calculate ROE, you basically just take the net income, which is self-explanatory, and you divide that by shareholder equity. To keep things simple, think of shareholder equity as just assets minus the liabilities of a company. So you want this figure to be rising steadily over time, and you want it to be higher than other companies you are comparing it to. And remember, when you are comparing these types of measures, valuation measures, you always want to make sure that you're comparing it to a comparable company, and furthermore, to a company relatively the same size and the same maturity in its business model. Now, one thing I want to point out is that even though you want to see this figure rising, there's a few ways that could be misleading. So for example, the healthy way, the way you want ROE to be increasing, is by the numerator increasing, by net income growing, because the company has better margins, because they're making better use of their capital, of their equity. Right? Now, the bad way that you don't want to see the company growing is if they're taking on massive amounts of debt and borrowing large amounts of debt in order to buy back shares. And that can actually make it seem like ROE is growing over time. Meanwhile, the underlying factor for why it's growing is not necessarily a healthy thing for making a prudent investment. And so hopefully this video makes you understand ROE a little bit better. And if it does, and if you like these types of videos, I plan to make many more on fundamental analysis. We'll jump into options trading strategies. I'll of course cover some crypto stuff. So make sure to like the video, comment your thoughts if it helped you, if I need to clarify something a bit more for future videos, and make sure to subscribe. The channel's growing. I'm going to be pumping out a lot of content this year. It is a great year to grow our portfolios. It's a great year to enhance your knowledge base when it comes to investing, stocks, crypto, options, trading strategy. We do it all on this channel. So I'll see you guys in the next video. Tell your investing friends about me.